Welcome to The Tax Factor, the top 20 business and investment podcast from Blick Rothenberg, the tax, accounting and business advisory firm. This week with Heather Sell and Tomm Adams.
Welcome to The Tax Factor, the top 20 business and investment podcast series from Blick Rothenberg that keeps you up to date on all the latest tax news. I'm Heather Self, and joining me this week to talk about all things tax is both a new face at Blick Rothenberg and a new voice to The Tax Factor. It's Tomm Adams. Welcome, Tom.
Well, thank you very much for the warm welcome, Heather. Pleasure to be here. And, really joining a new firm at the start of a new tax year is very much on brand for my new year, new me. So, Heather, have you got any new tax year resolutions?
Well, Nimesh and I did talk about those just before the start of the tax year, but there's one more I'd like to mention. People might be getting in the post over the next week or two their new tax codes, their PAYE codes. And just to mention that it's worth checking those because about 10% of codes are wrong. Let's start with a question to Tom. What's your tax code, Tom?
I actually did check this the other day. It was 1171L, I think.
Right, that's a fairly standard tax code. The personal allowance these days is 12,570. So if you've got very straightforward tax affairs, your tax code will be 1257L. That's 10% of the personal allowance. Because yours is a bit lower, Tom, you must have either some taxable benefits or some other income that's using up a bit of your personal allowance. If you've got a tax code that's something like BR, then that means that all of your income is being taxed and you're not getting the personal allowance. That's fine if you're using the personal allowance against another job, but it's worth checking. My husband's now retired and he's got several small pots of pension income, and he got a new tax code which said all of his income was going to be taxed at 40%. And I thought, oh no, it's not. I solved that by ringing HMRC, which did take me the best part of an hour, but I did get through and they were very helpful, and they realised they'd used the wrong codes on all of his income. So he's now getting much more tax allowances than he was before. You can also do it online if you've got an hmrc.gov.uk account. That should be quicker once you've got the account set up, which is a bit of a pain, but definitely worth checking your tax code, particularly if you've just changed jobs like Tom, or if you've got more than one job, or if you've just retired, or if you're not sure whether your tax code's right, do go online and check it. Moving on from tax codes, it's been a pretty big week in politics this week. We're starting to hear some more announcements, particularly from the Labour Party. What have they said about pensions, Tom? I know that's your specialist subject.
Yeah, Heather, that's very much my specialist topic. So it has been a big week in politics, not only with local council elections going on in England, and as we wait for sort of results to come in, which might well set the tone as to which way a national election might go later in the year. But Labour made a pretty big pledge over the weekend to maintain the so-called triple lock on the state pension, at least guaranteeing it for the next government. So that's a pledge that both the Conservatives and the Labour Party have made. Question is, so what does that really mean and why is it special? And from my perspective, it's interesting to look at how that differs from other countries around the world. Basically, the triple lock pension means that the state pension will go up every year in line with the higher of average earnings growth or inflation growth, or 2.5%. That's actually pretty unique. I'm not aware of another country in the world that has such a generous system. And despite the fact that that is quite generous, obviously there's quite a lot of pessimism around and a lot of people thinking, well, actually, is the state pension enough to live on? And from that perspective, pension industry guidelines generally say that to maintain a minimum standard of living, pensioners need around, in today's terms, £14,500 per year of income. And now the state pension is currently at 11,500. So it's sitting a little bit below that. Obviously, from the pensioners' angle, keeping the triple lock in place is indeed a really good thing. But with both Labour and the Conservatives promising to maintain this triple lock, a lot of people are asking, where is the money going to come from? Now, there was actually something just very recently in the press where Labour has made a comment about the Conservatives' plan to remove national insurance contributions, and Labour is contesting that that's actually going to create a massive black hole in the finances, and there will be an increasing gap in the state pension as a result. Now, Heather, what do you think about that? Do you think those claims are valid?
I think that's a bit of scaremongering, and actually I'm quite disappointed to see Labour descending to that level because, firstly, the idea that national insurance could be abolished is just mad. It brings in too much money, and there are forever calls to combine it with income tax, but that would just mean everybody would realise that they're paying much more tax than they are aware of. So I think that's was a bombshell that the Conservatives threw in just to be difficult, and Labour, to some extent, have taken the bait and are running with rather silly stories. National insurance, yes, it's used to fund the state pension, but it's not an absolute £1 of this funds £1 of state pension. It's more that the state pension is funded out of general taxation, and national insurance, frankly, goes into the general tax pot as well.
Completely agree, Heather. Looking at different social security regimes across the world, it's clear that there are countries that really do look more in granular detail at how that social security taxation is collected and allocated between different pots. For example, if you were a French employee, you would have probably about 10 or 15 different line items showing where your social security is going towards unemployment, towards health, towards disability benefits, and of course towards pension. That's just not the way that we look at it in the UK. However, what I do think is that if there were some move to merge the national insurance and the income tax system, that would create really widespread confusion when you have something like a cross-border working scenario where people perhaps seconded into the UK wouldn't expect to pay national insurance if they're paying in their home country. So really, just abolishing that creates confusion on the part of the taxpayer and the tax system on the whole.
I really don't think we were going to see it abolished. I think we might see some changes to national insurance. I think we might see national insurance charged on pensioners' earnings in the next parliament, even though that would be unpopular. I also think we might see some increases in national insurance for the self-employed, because at the moment, the self-employed still pay quite a bit less in national insurance than those who are just in ordinary employment. The main reason for that is that, of course, the self-employed just pay their own national insurance. They don't get employers' national insurance as well. If it was me, I'd put national insurance equivalent to employers' NI on large partnerships such as big accounting and law firms.
An interesting choice to make. Don't know if that's one that I would necessarily agree with, Heather, but we'll see how that pans out.
We will. One other thing that has been mentioned in the press about possible tax changes is that apparently there's a suggestion that Labour might reduce the VAT threshold. It's been 85,000 for a long time, and it's recently gone up to 100,000. There's a suggestion that Labour might reduce it to 40,000. Now, that would be massively unpopular with a lot of people. Small businesses would see it as more hassle. People like me, who employ self-employed builders and kitchen designers and so on, would suddenly find we'd have to pay VAT on their fees when they're just one-man bands. However, there has been some research done, particularly by a chap called Dan Needle, who's a former leading lawyer with a major law firm and now writes a lot on tax policy matters. And he's done some statistical analysis showing that for the self-employed, there's a real bunching of earnings just below the VAT threshold. And the suspicion is it's twofold. Firstly, the VAT threshold is enough for a one-man band or one-woman band to earn quite a nice living without crossing the VAT threshold. And that's on the assumption that any materials that the customer wants, they just buy themselves, so it doesn't go through the tradesman's turnover. But it's not enough really to take on an employee. And so what you get is a lot of one-person businesses, when actually for the economy as a whole, it would be better if there was some growth in employment. And for example, an experienced builder could then take on an apprentice. So it would be more efficient to reduce the VAT threshold. And the UK is out of line. Most of Europe has much lower VAT thresholds, so that you just exclude the very small hobby businesses, but anybody who's earning a living would be charging VAT. It would be unpopular. My bet is therefore that if it does happen, it'll be early in the next parliament rather than later.
And so, Heather, if you were in charge of VAT policy, where would you pitch the threshold?
I'd probably freeze it for a while and then take it right down to about 20,000, so that somebody who is just doing a bit of part-time work doesn't have to bother with it. But anybody who's actually running a business should be registered for VAT. It would encourage better compliance, and it would also level the playing field between the very small and the medium-sized businesses. But they'd never make me Chancellor. Talking about things happening in politics, this week we've seen the First Minister of Scotland, Humza Yousaf, resign. Scottish tax is a bit different from English tax, but not completely. Is that right, Tom?
Yeah, that's right. The power to control certain aspects of taxation was one of the devolved powers granted to Scotland. Interestingly, Wales also has the ability to change their tax rates, but they haven't actually derogated from the sort of central Westminster rates to date, at least in income tax. There's a few different buckets of taxes in Scotland with differing ways ways in which Holyrood controls the changes in taxation. For example, there are fully devolved taxes such as land and buildings transaction tax, which Scotland has complete power over. And then there's assigned taxes. So one of those is VAT at the moment. So that's where the rate is centrally set, but a certain amount of that taxation revenue goes directly to Scotland. And then in the middle, there's these partially devolved taxes. And now personal income tax is one of those at the moment. And it's a bit of a weird halfway house in a way, because Scotland will drive their taxation from certain Westminster principles. For example, they still have the UK-wide personal allowance of £12,570 a year, but then they will set taxation thresholds and percentages above that amount. And what I found interesting is the structure changed from 6th of April this year. They introduced a new contribution rate of 45%, which comes in between £75,000 of taxable income and £125,000-ish. And then there's an additional rate on top of that of 48%, which is 1% above where it was prior tax year and 3% above the tax rate in the other constituent nations of the UK. Now, it's interesting because the purpose, or at least the way the numbers work, appear to be so that rather lower earners will pay tax at a headline marginal rate of 19%, so a little bit lower than the 20% in the rest of the UK. But then obviously, as you get to the higher earning thresholds, then the gap between the more heavily taxed higher earners and the less heavily taxed lower earners actually increases. An interesting quirk as well that taxpayers in the whole of the UK will find is because over £100,000 of income, your personal allowance is actually reduced by £1 for every £2 of additional income you get. It creates this really weird sort of stealth marginal tax rate of, in the rest of the UK, 60%. Now, in terms of the numbers, how that works out, broadly, it's your baseline marginal rate of 40%. And then in addition to that, for every £2 of income that you have above the 100,000 that erodes from your personal allowance, you attract an additional 40 pence of tax. So that's the equivalent then of 20p of tax in the pound, 20% plus the original 40%. So that's 60%. What you find in Scotland now is something slightly more eye-watering, because you've got, instead of that 40% marginal rate, you've got 45%. So you're pulling in an additional 22.5 pence of tax per pound of income above the £100,000 threshold up until you reach 125,000 and a little bit. And that kind of creates this stealth tax rate of 67.5%. And that's even before national insurance. So it feels a bit eye-watering to say that if you are somebody who earns within that tax bracket, you would actually end up paying a marginal rate of 69.5% combined personal tax and NIC. On the other hand, some people would say that's a very nice problem to have.
Indeed. I think these excessive marginal rates, and they do happen at various points in the tax system. My preference would be for a government to be honest and say, let's just give the personal allowance to everybody, but have a marginal rate of 60% for a certain band of income, which effectively claws it back, but you do it as rates of tax so that people can see what rate of tax they're paying. And I think that would then make it easier gradually to align them so that nobody pays more than, say, 50% at most. But as I say, nobody's going to make me Chancellor. And finally,
it's time for another bizarre VAT update.
Yet another VAT and food case. We did cover the Walker's Poppadoms case in one of our podcasts back in about January or February, but apparently Walker's are now going to appeal it to the upper tribunal. What do we need to know about the Walker's Poppadoms case, Tom?
Well, broadly speaking, the case concluded with the first tier tribunal that Walker's Sensations mini poppadoms really are like potato crisps. But what I thought I'd do, Heather, is actually just do a little quiz for you and see how well you know the case. Just ask you a few questions and see how you get on, if that's okay.
That's fine. Off you go.
Good stuff. So here we are, the Great British Poppadom Quiz of 2024. This morning I went on Tesco.com and a sharing bag of Walker's Sensations Poppadoms was advertised at £2.50 non-club card price. Assuming this includes standard rated VAT, what would be the price before VAT? Is it A, £2 exactly, B, £2.08, or C, £2.13?
I'd say £2.08.
That is exactly right. Of course, that's standard rate VAT of 20%. The net price would be £2.08. Good mental arithmetic. Question 2. Which of these is not a flavour of Walker's Sensations Poppadoms? A, mango and red chilli chutney. B, lime and coriander chutney. Or C, hedgehog flavour?
I'd go with probably hedgehog.
You are exactly right. For those who don't remember, there was actually a period of time where we had hedgehog flavour crisps on our shelves. And so the tribunal essentially concluded that regardless of the type of flavouring that you have of poppadoms, there are just as many flavours of crisps that abound. And so having something unique like a chili chutney flavour does not make something distinct from regular potato crisp. Question 3. What percentage of a mini poppadom was claimed by Walkers to be made of potato? Was it A, 17%? B, 40%, or C, 50.5%?
Well, if they'd said 50.5, it would definitely have been a potato-based snack. I suspect they tried to argue for the lowest figure. That's 17%.
Yeah, that's exactly right. So the ingredients point out several potato-like ingredients, which sort of range from 17% for potato granules, same for potato starch, and 4% modified potato starch. And really, the argument was about which of those should be included. And eventually, the tribunal concluded that all of those should be totted up to form how much of it was made of potato, which comes to about 40%.
Excellent. We do keep seeing these food-related VAT cases, and the main reason is that if a producer can convince HMRC that their product ought to be zero rated, frankly, they just make more profit. I don't see the price of a pack of poppadoms coming down to £2.08 if Walkers win the appeal, but we'll have to see. We're almost out of time for another week. If you enjoy our podcasts, you might be interested in our video series of success stories. Each episode features a successful business leader who talks about their journey and offers their advice to other businesses and fellow entrepreneurs. In the latest episode, Daniel Burke from Blick Rothenberg talks with Dino Sura, Managing Director of global restaurant business Burger and Lobster.
I'm really looking forward to listening to that. It's a great series, and it's really great to hear about the businesses that come onto the programme.
You can find them on the Blick Rothenberg website or on YouTube. Tom, it's been great having you along today.
Thank you, Heather. I look forward to coming back soon. And next week, it's Rahanna Earl and Roger Holman in the hot seats.
I'm Heather Sell. Thanks for listening. Enjoy your weekend and goodbye.
That's the Tax Factor. We'd like to thank you for making us one of the UK's top 20 podcasts. Find all our previous episodes wherever you get your podcasts. And join us again next time on The Tax Factor.